Warren Buffett has kept the majority of his personal wealth in stocks for over 6 decades. Not bonds, not cash, not the kind of safe, stable instruments most financial advisors point ordinary savers toward. A man with more money than he could spend in 1,000 lifetimes deliberately avoids the very things we are told to rely on. That choice has a reason behind it, and the reason has everything to do with what we are talking about today. Compound interest is supposed to be the one rule that always works. Put money in, give it time, watch it grow. That is what we were all taught. The problem is that the rule was designed for an era when inflation ran at 2% a year or less. Predictable, slow, easy to outpace. Today, the average American household spends roughly $1,000 more per month than it did just 4 years ago. That is not a temporary spike. That is a permanent reset in the cost of living. And compound interest was never built to run that fast. So here is what that actually means in practice. Your account balance can grow every single year, and your actual purchasing power can shrink at exactly the same time. The number goes up, what it buys goes down, and the gap between those two things widens quietly. Every month you stay on the old plan, which raises a question worth sitting with. If the strategy has not changed, but the cost of living has, what is silently happening to everything you have saved so far? That question has a specific answer. The compounding engine you were taught to rely on is now running directly against an inflation current strong enough to cancel out its gains. Understanding exactly how that works and what actually replaces it is what this video is about. Because every month you keep measuring success by your account balance instead of your purchasing power, the erosion keeps happening, and it does not show up anywhere on your statement until it is too late to ignore. My name is Alex, and if you have ever watched your savings grow and still felt like you were falling behind, pay close attention, because the issue is not your discipline, it is the measuring stick you were given. And I'm going to show you why purchasing power is the only number worth tracking, and which assets are actually built to grow with inflation rather than lose to it. Once you understand how that works, you will not just see your finances differently, you will make fundamentally different decisions with them. The damage this causes is more concrete than most people expect, and it always starts the same way. Here is something that does not get talked about enough. Doing everything right with money is no longer a guarantee that you are actually getting ahead. Most people assume that if they are saving consistently, the math is working in their favor. And for a long time, that assumption was reasonable. You contributed. The account grew. The future looked more secure every year. But that relationship between saving and security has quietly broken down. Not dramatically. Not all at once. Just slowly enough that most people do not notice until the numbers stop adding up the way they expected. This is not about people making mistakes. It is about a strategy running into conditions it was never designed to handle. Think about what inflation has actually done recently. In 2026, the cumulative price increase since 2020 sits at roughly 23% across everyday consumer goods. Groceries, utilities, insurance, rent, the things you cannot cut out of your life. That means a dollar that bought 100 cents worth of goods 6 years ago now buys around 77 cents worth of the same things. The dollar did not disappear. It just quietly lost a quarter of its power while sitting in your account, looking perfectly fine. Now here is where it gets personal. Take someone like Daniel. He is 38, works as a project manager at a mid-sized logistics company, earns around $91,000 a year, and has been putting away $250 every single month since he was 30. Disciplined, consistent, no missed contributions. By the time he hits 50, he will have contributed $36,000 of his own money. With a conservative 5% annual return, his statement will show somewhere around $54,000. On paper, that looks like a win. He turned $36,000 into $54,000. $18,000 of growth without doing anything except staying consistent, but run the inflation math alongside it, and the picture changes completely. If prices continue rising at an average of 4% annually over that same period, the purchasing power of that $54,000 in today's terms is closer to $33,000. He saved for 20 years. He never missed a month. And in real terms, he ends up with less purchasing power than he put in. Let that land for a second. 20 years of discipline. The net loss in real value. And look, this is not Daniel's fault. He followed the rulebook exactly as it was written. The problem is that the rulebook was written for a different economy, one where inflation stayed quiet, stayed low, and stayed predictable enough that even modest compound growth could stay ahead of it comfortably. That economy existed for a long time, long enough that the advice built around it became gospel. Save early. Stay consistent. Trust the math. The math still works. The assumptions underneath it do not. Here's the part that makes this especially frustrating. The damage is invisible while it is happening. Daniel's statement never shows a loss. Every month, the number goes up. Every year, the account looks healthier. The erosion does not announce itself. It just shows up one day when he tries to convert that balance into an actual life and realizes it buys less than he thought it would. This is what financial advisors rarely say out loud. Nominal growth, the raw number your account shows, is not the same as real growth. Real growth is what remains after inflation has taken its share. And right now, for millions of people doing everything they were taught to do, that real number is either razor thin or quietly negative. So the strategy is not broken because people are careless. It is broken because the environment changed and the strategy did not, which naturally leads to the next question. Why did the environment change this dramatically? And why has it stayed this way? Because once you understand the forces that created this pressure, you start to see why this is not a temporary problem waiting to correct itself. And that is exactly what we need to look at next. The cause behind the damage. Most people treat inflation like weather, something that just happens, something outside the system, unpredictable, nobody's fault. But inflation at this scale does not just appear. It gets built. And once you see exactly how it was built, the fact that your savings are struggling to keep up starts to make complete sense. Start with the money supply. Between 2020 and 2022, the United States added roughly $6 trillion to circulation. That is not a typo. $6 trillion created and pushed into the economy in under 2 years, primarily through government stimulus programs and Federal Reserve bond purchases. To put that in perspective, it took the United States over 200 years to accumulate its first $6 trillion in circulation. Then it happened again in 24 months. Now think about what that does to prices. More money chasing the same amount of goods means each dollar is worth a little less than it was before. That is not an opinion. That is just arithmetic. And it would have been manageable on its own. The problem is that it did not happen on its own. At the exact same moment that the money supply was surging, global supply chains collapsed. Factories shut down, shipping routes backed up, container shortages delayed goods by months. The shelves had less on them precisely when more money was available to spend. You had a flood of new dollars meeting a shrinking pool of available products. That combination is an inflation engine, and it ran hot. Then energy costs spiked. In 2022, the average U.S. household spent around 30% more on energy than it did in 2019. Heating, fuel, electricity, energy touches the cost of everything. When it rises, every business that moves, stores, or manufactures anything passes that cost forward, which means prices rise across the board, not just at the gas station. And here is where it gets self-reinforcing. Rising prices push workers to demand higher wages. Higher wages push businesses to raise prices further to protect their margins. That cycle does not stop cleanly. It runs until something forces it to slow down. The Federal Reserve spent most of 2022 and 2023 aggressively raising interest rates, trying to do exactly that. By mid-2023, the federal funds rate hit a 22-year high. It worked partially. Inflation cooled from its peak of 9.1% in June 2022. But in 2026, core inflation is still running above 3% annually, which means the pressure did not go away. It just became the new baseline. That baseline is the part most financial planning ignores. Here is the only math that actually matters right now. Real growth equals nominal growth minus inflation. That is it. That is the entire equation. If your savings account is earning 2.5% interest and inflation is running at 3.2%, your real return is negative 0.7%. The number in your account went up. Your purchasing power went down. Both things are true at the same time. Now you're probably thinking that does not sound like a huge difference. Less than 1%. How bad can it be? Run it over 20 years, and it is the difference between retiring with the life you planned and retiring with a version of it that keeps shrinking every year you live it. This is the gap that never shows up on a statement. Your bank does not send you a letter that says your real return this year was negative. It just shows you the bigger number and lets you feel good about it. The erosion happens off the page. And that is the real cost of staying on the old plan. Not a dramatic loss, not a crisis you can point to, just a slow, steady, invisible drain that compounds in the wrong direction while everything on paper looks fine. So now you know what caused the damage and why it has not corrected itself. The environment is not going back to what it was, which means the strategy has to change. And that change starts with a completely different way of thinking about what your money should be doing. A new principle that flips the relationship between inflation and your savings entirely. Here is a shift that changes everything once you see it. The problem was never that compounding stopped working. The problem is that most people are compounding the wrong thing. Traditional savings advice is built around a fixed return. You put money into an account, a bond, or a certificate of deposit, and it pays you a set rate, 3%, 4%. Whatever the number is, it stays the same, regardless of what happens to prices around it. That stability feels safe. It feels predictable. And in a low inflation environment, it was enough. The fixed return stayed ahead of rising costs without any effort. But fixed means fixed. When inflation accelerates, the return does not move with it. The environment changes, the payout does not. And that gap between a static return and a rising cost of living is exactly where purchasing power goes, to disappear. So the principle is straightforward. Stop anchoring your savings to fixed returns. Start anchoring them to income that moves. This is the distinction between fixed income and floating income. Fixed income pays you the same amount regardless of what the economy does. A savings account paying 2.4% today will still pay 2.4% when groceries cost 15% more. Floating income adjusts. It is tied to something real. A rent payment that can be raised when the market moves. A dividend from a company with enough pricing power to pass its rising costs onto customers and still grow its payout. A royalty tied to revenue rather than a flat fee. An income that breathes with the economy instead of suffocating under it. The mental shift here is subtle, but important. You are not just looking for growth anymore. You're looking for growth that stays connected to the real world. Think about what a bond actually is. You lend money to a government or corporation. They pay you a fixed rate for a fixed period. At the end, you get your principal back. That structure made sense when inflation was stable and predictable. But when inflation runs above your fixed rate, every single payment you receive is worth less, in real terms, than the one before it. You are not earning a return. You are subsidizing the borrower while your own purchasing power shrinks. Most people holding bonds right now have no idea that is what is happening. Now flip that. Think about owning a share of a business that sells something people need, regardless of the economic climate. In 2026, companies in sectors like consumer staples, healthcare, and infrastructure have continued raising their dividends, even as costs have climbed. The average dividend growth rate among S&P 500 dividend growers has run at roughly 6% annually over the past decade. That is not a fixed payout sitting still. That is income rising faster than the baseline inflation rate. The return is not anchored to a contract written years ago. It floats with the performance of real businesses operating in the real economy. And here is the second part of the principle. It is not enough to earn a floating income. You have to reinvest it. This is where the compounding actually happens. When you take the income your assets generate and put it back into more of those same assets, you are not just growing a number. You are growing your future income stream. More assets generate more income. More income buys more assets. The cycle builds on itself. And because the income is floating, the entire cycle adjusts upward as prices rise instead of getting quietly eroded by them. That is the engine the old strategy was missing. Not a higher interest rate, not a better fund, a fundamentally different relationship between your savings and the economy in which they live. This is not a complicated idea, but it does require letting go of the comfort that fixed returns provide. Predictability has a price, and in the current environment, that price is your purchasing power. The principle is clear. What it looks like in practice is where most people get stuck, because floating income sounds reasonable in theory, but the real question is where exactly it shows up and whether any of it is actually accessible without being wealthy already. That is what the next part answers, the full range of options, and how to think about which ones fit where you actually are right now. Here's the part where most financial content loses people. It introduces a compelling principle, then illustrates it with an example that has nothing to do with anyone's actual life. Apartment buildings, private equity, commodity futures. The theory sounds right, but the entry point feels completely out of reach. So before anything else, let's be direct about this. Floating income assets are not reserved for people with seven-figure portfolios. They exist at almost every income level. The question is just knowing where to look. Start with the most accessible one, dividend-growing stocks. In 2026, you can open a brokerage account with as little as $1 and start buying fractional shares of companies that have raised their dividends consistently for decades. Companies like those in the S&P 500 Dividend Aristocrats Index have increased their payouts every single year for at least 25 consecutive years. These are not obscure bets. These are large, established businesses in sectors like consumer goods, healthcare, and utilities. Businesses that sell things people need, regardless of what the economy is doing. When their costs rise, they raise their prices. When revenue grows, the dividend grows with it. The income floats. That is the whole point. Now you're probably thinking the yields sound small, and on paper, 3% does not feel exciting. But remember the principle. You are not holding these for the yield alone. You are reinvesting every dollar of that income into more shares. More shares generate more dividends. More dividends buy more shares. Over 10 years at a 6% dividend growth rate, the income your original investment throws off nearly doubles. The yield on your original cost basis climbs well above what any savings account will ever pay, and it keeps climbing as long as the business keeps growing. The second option is real estate, not necessarily owning a physical property, though that remains one of the most reliable floating income vehicles available. When inflation rises, rents tend to follow. A landlord with a well-located rental property in a supply-constrained market has meaningful pricing power. In 2026, the national median asking rent sits around $1,940 per month, up roughly 31% from 2020. That is a landlord's income moving in the same direction as the cost of living. That is floating income in its most direct form. But if direct property ownership feels out of reach, real estate investment trusts, known as REITs, offer the same basic exposure without the down payment or the maintenance calls. REITs are required by law to distribute at least 90% of their taxable income to shareholders. Many of them own inflation-sensitive assets like apartment complexes, storage facilities, and healthcare properties. The income they generate tends to rise with the broader price level, and they trade on the stock market like any other share, accessible with a standard brokerage account. The third option is one most people overlook entirely: skills with pricing power. This is not a stock or a fund. It is the income your own labor generates. A nurse, a software contractor, a licensed tradesperson, a consultant with a specialized expertise. These are people whose earning potential rises with demand. In an inflationary environment, skilled labor commands higher rates precisely because everything else costs more too. Investing in a certification, a credential, or a deepened area of expertise is not just career development. It is building a floating income stream attached to your own name, one that adjusts with the market because you have something the market genuinely needs. Each of these options sits at a different entry point and carries a different risk profile. Dividend stocks require patience and tolerance for market volatility. Real estate requires capital or access to REITs. Skills require time and deliberate investment in yourself. None of them is perfect. All of them share the same core property, and the income they generate moves with the economy rather than against it. The principle from the last section is not theoretical. It is available, right now, at your current income level. The only remaining question is what it looks like when someone actually builds it from the ground up. And that is exactly what the proof shows. One person, one starting point, and what dynamic compounding actually produces over time. Principles are easy to agree with. The harder question is always whether they actually hold up when someone really tries to apply them with real money, a real job, and a real life that does not pause while they figure this out. So let's make it concrete. Marcus is 41 years old. He works as a licensed electrician running his own small contracting business in the Midwest. He earns around $86,000 a year. Not wealthy, comfortable, but watching costs climb in every direction. His materials cost more. His fuel costs more. His insurance costs more. He knows the standard savings advice better than most people because he followed it faithfully for years. And he reached a point where the account was growing, but the feeling of progress was not. 5 years ago, Marcus made two decisions. First, He took the $240 a month he had been putting into a low-yield savings account and redirected it into a simple portfolio of dividend-growing stocks. He was not chasing the highest yield. He was specifically looking for companies with long track records of raising their payouts, consumer staples, healthcare, infrastructure, businesses that had kept raising dividends through the 2008 financial crisis, through the 2020 pandemic, and through the inflation surge that followed. He found a handful that had raised their dividends every single year for over 25 consecutive years. Second, and this is the part most people skip, he made one rule for himself. Every dividend payment that hit his account went straight back in. No exceptions. Not when the market dropped. Not when a slow month made the temptation to pull it out feel reasonable. Every dollar of income bought more shares. Every additional share generated more income. He treated the reinvestment as non-negotiable, the same way he treated his monthly contribution. Now run the numbers on what that actually produced. Over 5 years, Marcus contributed $14,400 of his own money at an average dividend yield of 3.2% with a 6% annual dividend growth rate, and with full reinvestment throughout. His portfolio in 2026 is worth approximately $19,800. That is a nominal gain of around $5,400. But here is where the real story is. The income his portfolio now generates every month has grown from roughly $38 in month 1 to approximately $61 today. That is a 61% increase in monthly income over 5 years. Over that same period, cumulative inflation ran at roughly 23%. His income grew at nearly 3 times the rate that prices did. That is dynamic compounding, not a theory, not a projection built on best-case assumptions. A real outcome from a straightforward strategy applied consistently over 5 years to a working person's income. And notice what drove it. Not a spectacular return in any single year. Not a lucky stock pick. Not a market timing call that happened to work out. The compounding came from the combination of floating income and disciplined reinvestment. Each dividend payment bought more shares. Each additional share raised the next dividend payment slightly higher. The cycle fed itself. And because the underlying income was growing rather than fixed, the entire machine accelerated slightly every year instead of running at a flat rate. This is also why the starting amount matters less than people think. Marcus did not begin with a large lump sum. He started with $240 a month, and a rule he refused to break. The strategy does not require wealth to begin. It requires consistency and the right structure. Now look at where Marcus stands compared to Daniel from earlier. Daniel saved faithfully for 20 years into a fixed return account and ended up with less real purchasing power than he put in. And Marcus saved for 5 years into floating income assets with full reinvestment and came out ahead of inflation by a significant margin. Same discipline, completely different outcome. The only variable was the structure of the income each of them was compounding. The gap between those two outcomes is not luck. It is not timing. It comes down to one final shift in how you measure whether any of this is actually working. And that shift is what everything in this video has been building toward. Here's what this whole video really comes down to. The savings strategy most people are using was built for an economy that no longer exists. That is not a personal failure. It is a timing problem. And timing problems have structural solutions. The mechanism is straightforward once you see it. Fixed returns erode under inflation. Floating income adapts to it. Reinvesting that income compounds the adaptation. And measuring real purchasing power instead of nominal balance tells you whether any of it is actually working. So here's the question worth sitting with after this. Look at where your savings currently live. Are they generating income that rises with prices, or income that stays flat while prices climb around it? That single distinction is worth more than any budgeting system or savings rate optimization you will ever find. The natural next question is what happens when you combine this approach with the way debt behaves during inflationary periods? Because inflation does something to borrowed money that most people never think about until it is too late to use it deliberately. That is a conversation worth having. If this reframed something you had been sensing but could not quite name, share it with someone who is asking the same questions.